Good afternoon, everybody, and welcome to today's Dunstan Thomas Lunchtime webinar. I'm Adrian Boulding. I'm Director of Retirement Strategy at Dunstan Thomas, and it's my role today to chair this seminar and get us through to a prompt and timely finish at 1 o'clock. So thank you for lending us your lunch hour. This is our third visit to the topic of SIPPs and SSAS, and this time we're looking at the specific issues that may surface when the boss decides to sell the business. That sale is often a critical time in the life of a pension scheme, and from my own experience, it's one that's often thought about only at the very last minute in something of a panic. To help us with the issues today, we have three titans from the world of SIPP and SSAS. We have Martin Tilley, who is interim chair of the Association of Member-Directed Pension Schemes and a director and head of technical compliance at Westbridge SSAS. Martin, as many of you may know, is a fellow of Pensions Management Institute and has spent nearly all of his 39-year career advising on self-invested pensions. He's held senior roles at specialist SIPP and SSAS providers, as well as a wealth manager, fulfilling technical compliance and advisory functions. Martin is a well-known industry spokesperson, writing and presenting education pieces, and is currently the interim chair of the Association of Member-Directed Pension Schemes, AMPS. Our second speaker today is going to be Ian McCullum, Technical and Compliance Manager from your SIPP. Ian has over 20 years of experience in the financial services industry with a wealth of knowledge across a range of sectors, including retail banking, insurance, assurance, wealth management, and employee benefits. For the past 8 years, Ian's focus has been on the specialist SIPP and SSAS market. He's worked for some of the biggest names in the member-directed arena, concentrating on operations, technical, and compliance matters. Ian keeps abreast of regulatory developments and best practices in the industry, ensuring that your SIPP complies with all legal and regulatory standards. And our third speaker today is going to be Barry Foster, Technical Sales Manager at the Curtis Banks Group. Barry joined Curtis Banks as Technical Sales Manager in November 2020 in a newly created role as part of an expanded group sales team. Barry brings over 20 years' experience in the financial planning sector, most recently developing a strategic and technical proposition at BMO Global Asset Management. Prior to BMO, Barry was a technical sales manager at Utmost Wealth Solutions and AXA Wealth. The format today is that each of our three guests will speak for around 5 to 7 minutes, and then we'll move to address audience questions. Please do submit your questions as we go along using the Ask a Question button that you should be able to see middle bottom of your screen. And if you've been to one of our webinars before, then you'll know that within that Ask a Question facility, you can also vote for the questions that you think would be best answered. What we will do is we will tend to pick the questions which come up best and choose those ones first ahead those of lower votes. So to move us along, we will begin with our first speaker, and I will hand over to Martin Tilley.
Thank you, Adrian. Good afternoon, everyone. For those of you who've known me, you'll know I love SSASs with a passion. I first started dealing with them back in, I think, 1984. They can be tricky things. I'm always amazed that, we're talking about a large amount of acquisition and merger activity. It's generally the smaller and medium-sized businesses that I think we're talking about, and these are the prime market for small self-administered schemes. I'm forever amazed that there aren't more of these. I think they are misunderstood, and should be more used. Every time I present to financial advisors, they always seem to be amazed at the flexibility and the features that SSASs offer. So I think there should be more of them. But having said that, they are occupational, and in the instances of what we're talking about here, the sale of a business, they are intrinsically linked to the employer, and therefore they can be a slightly more complicated vehicle to deal with when you've got a transaction. It does, however, mean massive planning opportunities, and I emphasise, as Adrian said before, this is something you do not want to leave to the last minute. There's big tax planning opportunities, tax planners, financial advisors, and for SaaS practitioners all working in conjunction. And starting off, with SaaS practitioners, wide variation amongst the market of the what I call the old school SaaS practitioners, who are very much, hand holding, very much personal contact with the clients, attend trustees meetings, in which case they're going to be well aware of these transactions, probably well ahead of when they're actually going to happen. So that's good news. But there is a wide range of SaaS practitioners, ranging right the way down to the, if I can call them, more reactive. And they may be less so able to help in terms of providing that consultancy. And you've still got, of course, orphan SaaS cases that don't have a practitioner attached to them at all. And in these instances, I think it's very, very important to rely on the other advisors, the other tax planners, accountants, solicitors who do know that these transactions are going to go ahead, to get somebody SaaS knowledgeable in the field as quickly as possible. So I think the first thing we need to perhaps consider is how should the deal be structured? If you know in advance there's an opportunity to plan the group company structure with subsidiaries, to see who the ongoing members of the scheme are going to be, whether it's going to end up being a company scheme, whether it might turn into a family trust, whether you might even want to split the SaaS, because of course companies can have more than one SaaS now. It might be that following the transaction, the deal, the SaaS has run its full purpose, and it might be that you might want to split the SaaS and transfer across to SIPPs. Other aspects to think about is final funding. Will there be a large final payment going in just prior to the deal, or actually as part of the deal? In which case you've got annual allowance issues, lifetime allowance issues. Does the deed allow, general and individual funds? Should we be bringing in any new members ahead of the deal? Do we want to bring them in 3 years ahead of the deal, so you've got the potential for carry forward to soak up excess funding? Do we want to bring transfers into the scheme? Do we want to consolidate existing pensions for members? Because post-deal, with no employment, with the November last year transfer regs, it might be slightly more problematic to bring transfers in post the deal. And of course, the big one for me is scheme documentation. Because again, you've really got to understand scheme constitution to understand where problems might crop up. So where do the powers lie within the deed? The powers to amend the deed, the powers to appoint and remove trustees, powers to appoint or allow new members. Do we need to close the scheme? Do those powers move? It's not uncommon. Some deeds will say that in the event that the founder employer ceases to be under the control of the member trustees, power will automatically move from the employer to the trustees. Not always the case. These changes need to be planned ahead of time. And don't forget that the vast majority of cases, all members will need to be trustees and need to have unanimous decision making. So all members need to be on board on that score. And scheme documentation it's not standard across the industry. In fact, it's not even standard across individual companies, particularly if you've got consolidating companies who've bought books of SaaSes. It's not uncommon to find that a particular company may be operating 5 or 6 or 7 different deeds. And because much of the legislation is overriding, there's sometimes, if I could say, a laziness not to update the deeds. You could find you've got very, very old scheme documentation, which would benefit from a refresh before any deal goes through. Moving on, looking at scheme assets. Are any scheme assets affected by the deal? Are there any loans outstanding? What are the terms of the loan? Will it be repaid? Are there any properties within the scheme that are lent to the leased to the company? Will the new company want to remain as tenant? Will they vacate? If they stay on board, they're no longer connected tenants. What does that mean? Other things to think of, sometimes the company provides services to the trustees. They might act as rental collection agent. They might do scheme returns. They might even act as scheme payroll agent. Will the new owners of the company want to take that on board? It's unlikely. We need to take that back in-house or outsource it to an accountant. Then you've got benefit planning, of course, probably more for the providers than the SaaS practitioners. But with this large pot of money moving around at point of transfer, will benefits come into payment? Will they be deferred? Will individuals be drawing down perhaps from personal funds rather than the pension scheme? If it's from the pension scheme, how's liquidity going to look? But with all this money moving around, almost certainly there'll be a reason to revisit the individual members' wills. And if you're revisiting a member's will, well, surely you want to be looking at the forms of nomination as well. Do the members understand the post-2015 death rules and regulations and how flexible those can be? So you can see, we have, a huge planning exercise which does need to be started well in advance. As Adrian said, please don't leave it to the last minute. I'm reminded of a case probably 3 or 4 years ago where we'd taken over a scheme. We were aware of a potential sale of the company. We got to the week of completion, and all of a sudden we find out that 10 years ago the pension scheme lent some money to the company, and a charge was taken over company assets. And although the loan had been repaid 5 years ago, the charge had never been released. So we frantically had pieces of paper flying around, desperately trying to get this thing done so it didn't hold up the deal. So, you do need to be very aware of these things. And none of the things that I've mentioned are particularly problematic. And many of those will overlap with both SIPPs as well. And undoubtedly, SIPPs will have their own issues. But with a SAS, I think do please handle with care. Do need to be aware of the intrinsic connections between the SAS and the employer. But with that conclusion, I'll hand back to Adrian.
Martin, thanks very much. Lots of food for thought there. Though, thank you for echoing that "don't leave it to the last moment" message. And we'll move straight on to our next speaker, Ian McCullum.
Thanks, Adrian. Yeah, and I think Martin covers a few of the points that I'm going to cover anyway. I think first and foremost, before a company decides on what solution is best for it, be it a SIPP or a SAS, it really needs to take some form of corporate advice to establish, firstly, the needs of the business at the present time and what the company's likely to look like going forward. The key considerations would be to look at the differences in the key features of a SIPP versus a SAS. For instance, is the business likely to want to lend money from a collective pension fund to the business in order to expand and grow? Of course, that's one of the main features of a SAS, the loan back facility. But also what investment strategies and attitudes to risk do each of the members within any arrangement have? Do they differ dramatically or are they relevantly on par? Whilst technically earmarking can be done in a SAS, it becomes rather more complicated in that all the members are trustees in a SAS, and they all have to be in agreement before allowing any earmarking orders to take place. Whereas a group of individual SIPPs coming together to buy a respective share of a common asset, such as a property, allows individual SIPPs more say over their own individual fund and investment strategies. I suppose in any case, before you agree to come together to pool funds, watertight agreements, as Martin had said, over who owns what and what percentage, and what you do towards the end of the process if directors leave or the company's sold, are really key, and they're often forgot about, perhaps complacently. And people don't always enter into business arrangements thinking one day that they'll sell the business, that they'll leave the business, or that they'll fall into dispute. But it does happen, and probably more often than what it should. In some ways, that's what makes a SIPP perhaps a lot cleaner. But again, it doesn't offer the aforementioned flexibilities that a SAS does in terms of the investment opportunities that are available. But deeds, legal agreements, unless you have templates, they can often be costly to draw up. And, some member trustees in a SAS, for instance, will see the bottom price of how much it will cost to put one of those agreements in place. And, they'll try and circumvent it and try and follow the cheaper option. Reluctant to pay, but actually when it comes to a dispute or a director's perhaps disputing the share of the fund that they have, they more often than not wish that they just paid that few grand to have that agreement put in place at the start. In essence, disentanglement should, for all intents and purposes, it should be easier on a SIPP because it is, it's a personal pension, it's an individual plan. And in theory, it should be just the same as a SAS if you have the relevant agreements that are in place that resolve what happens should certain things happen, like a director leaves the company or the company is sold. But of course, we all know, rightly or wrongly as well, that often the key differential between a product or indeed a provider is the cost. That's what most financial advisors will look at when they're trying to place a SIPP or a SSAS. But from a technical persuasion, it's not the most important thing. On the surface, one provider can look cheaper than the other. But how is that SIPP or that SSAS actually structured, and what processes does that operator have in place? So, for instance, SSASs, the members are the trustees. SIPPs can differ. You have member trustee SIPPs, which require the ratification of the member and usually that member's signature before you can finalise any transaction. What's the benefit to that? Well, the member has a more day-to-day active role in the running of that SIPP. But where the disadvantage, perhaps more so for the operator, comes into place is trying to get the member to sign off on a transaction or trying to sign something that the member doesn't want to sign. Perhaps they're not happy with the way the transaction's being conducted. And members can often refuse to sign, which means that you can't really legally ratify, any transaction on a member trustee SIPP. But again, it gives them that more day-to-day hands-on, interaction with the SIPP provider if they're actively involved with signing off the transactions. And then, of course, you have member trustees. You have corporate trustee-only SIPPs. Now, really, most SIPPs, I believe, these days should be corporate trustee-only. For the simple fact is that you're dealing with members who are often lay people when it comes to pension schemes. A SIPP is so wide stream now, whereas, perhaps rightly or wrongly, it was meant for perhaps the more financially astute, who had a reasonable, if not professional, awareness of how pension schemes operate and the certain transactions that you're required to sign off. But where a SIPP, for instance, is corporate trustee only, if the SIPP provider has to realise assets, for instance, some SIPP providers will have a clause in the terms and conditions that allows them to realise it from the last asset that you're invested in. Now, that's usually written into the terms and conditions with some providers, but it's not necessarily the investment that member would want that operator to disinvest from. Perhaps, let's say, gold is doing particularly well at the moment, but that was the last investment that the member invested in. So really checking the terms and conditions is really the best way to establish not just what the bottom line cost is, but what that member is really looking for. Are they a SIPP member that wants that hands-on role and that day-to-day interaction, or are they quite happy to put it in the hands of the corporate trustees? But irrespective, be it at the start of it or be it the disentanglement process, if we're calling it that, corporates have to receive, companies have to receive advice, not just individual advice on in terms of financial advice for the member, but corporate advice as to what the business is likely to look like, and realizing that whilst you're all starting off as friends, there may well come a day where you do have to have those difficult decisions, and the key thing there is to have the necessary agreements in place to ensure that there's no hiccups towards the end. And with that, I'll pass back to you, Adrian.
Ian, thank you very much for that. Yes, I think that corporate advice is often overlooked, and yet it is so important to the directors of a company, so that they can make informed decisions for their company. They can record in the board minutes who they've received advice from and what areas that advice covered. And it's a very, very important record that in years to come will enable them to say, yes, our firm was doing the right thing and we did take the right advice. Very valuable protections. We move to our third speaker. And we are on to Barry Foster from Curtis Banks.
Thanks very much, Adrian. So as a technical sales manager, my function really is predominantly at that sort of sales distribution, day one conceptual sales side of things. And although I'm comfortable with what is a SIPP, what is a SSAS, what are the benefits of a SIPP, benefits of a SSAS, pros, cons, drawbacks, etc., I don't and have never ran or administered a SIPP, and it's I just realise now having listened to both Martin and Ian, what a fantastically privileged position it is to be able to sell an idea, then not have to worry about the paperwork. But it is. I mean, I'm aware that there's paperwork, and I'm aware that there are agreements, and it's so important to get all of this right. So that's what this session. I could just as easily be happy as a delegate today, because it's such an important issue to think about day 2 and ongoing. You know, my function is very much to look at a situation, look at a scenario. What are the objectives? What are the purposes? What is it you're trying to do? Will a SIPP achieve that objective? Will a SSAS achieve that objective? What are the pros and the cons? It's conceptual stuff. So I'm actually very much looking forward to the benefit of Martin and Ian's practical hands-on experience to answer some of the questions today. I've got questions myself. From a Curtis Bank's perspective, we offer both SIPP and SSAS, so I've got no axe to grind at all, really. That said, on the one hand, SSAS, I mean, you've got to love a SSAS, haven't you? I mean, conceptually, I mean, I think of SSAS, and what do I think? I think this is an individually registered scheme. It's a unique scheme. It's, at least in theory, obviously every SSAS will be different, but at least in theory, you could have the widest possible range of retirement or investment options under a SSAS, because you're less likely to be constrained by what a SIPP or a personal pension provider is going to want to constrain you by virtue of reputational risk or whatever. So it's likely to be able to offer you the widest options in terms of investment and retirement. It's also a business planning tool. So the ability to hold your commercial property, your trading premises within the SSAS, and of course, loan back. And I think as well, from a family business, if you're expecting, we're talking about exiting a business today, but if it's a family business where you actually expect the business to pass down the generations, I think there might be a unique attraction to the owner of a family business, in that they might look at it not just as a pension plan, not just as a business planning tool, but also as they bring their children and their grandchildren into this family pension, this sort of pooled fund arrangement, that they might view it actually as an intergenerational wealth transfer. So I think it has a lot of attractions. So from the perspective of someone who sort of builds case study scenarios and delivers presentations, frankly, SSAS is just more interesting. That said, I think it would be very difficult to argue that a SIPP isn't simpler. You know, you don't have to establish or register your SIPP. Your provider will do that for you. You don't have to be a trustee, because your provider's dealing with all of that for you. Notwithstanding Ian's comments now, I suppose you can be a trustee. I think I'm a bearer of a simple brain, really. I like to break things down to simple terms. And my immediate reaction is, with a SSAS, I've got to be a trustee. With a SIPP, why would I? But, you know, maybe there are reasons. So also with a full SIPP, in reality, apart from loan back, you're probably going to be offered the same level of investment and retirement options under a full SIPP as you would under a SSAS. So there's probably not a huge amount to distinguish them. And I think, for me, I think the big issue is this member trustee issue. For some people, that will be absolutely right for them. And for others, they go running to the hills at the prospect. The other issue is that around the pooled fund, which is perhaps typical of a SSAS, but not at all typical of a SIPP. And I think the pooled fund offers advantages and opportunities. I was going to say it also offers drawbacks, but I think that's the wrong word. It also offers some challenges that need to be dealt with. So I think one of the big decision making aspects would be, is this pooled fund the right vehicle? And we may get into this today, I don't know, but it may well be for some that for business planning purposes, the holding of the trading premises or loan back, it might be membership of a pooled fund SSAS. But for purposes of privacy, for your own contributions, your investment strategy, managing your risk profile, you might also want to be a member of your own SIPP or personal pension alongside. So it may well be, notwithstanding cost issues, it may well be that a SIPP and a SSAS is the right solution, not just one or the other. So I've got a few questions I wanted to hopefully get answered today. Not so much answer myself. I got some thoughts around, you know, disentangling the SSAS from the business, removal of the sponsoring employer. All these, a SSAS I think is actually a much simpler vehicle in a lot of ways, subject to having the right expert. And, you know, Martin's intro just demonstrates the importance of having professional expertise behind you. I actually think with the right expertise behind you, a SaaS is perhaps less complicated to wind up or extricate yourself from than perhaps people fear. But it's all about planning. And there's something for me to learn here, because as I say, I present on a sort of distribution new business basis. I am a day one planner. But it's so important to think, right, okay, but where will you be in 10, 15 or 20 years time? And what do we need to think about? I'll throw one question out immediately, which we may or may not get to. And my big challenge is, and talking to an ex-colleague and friend of mine who's dealing with a SaaS, it's a family business. And this should hopefully be rare, but we all know that this isn't impossible. The big challenge for me with a pooled fund with member trustees, especially families, where one member just refuses to engage, simply will not respond to correspondence, simply won't sign anything, and it is just pure belligerence. And that to me is most of the other concerns, things like lack of liquidity, they apply equally to SIPPs and SAS, but it's this total intransigence of one party that's the thing I think is a sticking point. I'll be really interested to see from a practical perspective what my co-panelists think about in that respect. Back to you, Adrian.
Brilliant, Barry. Thanks for that. I'll make sure we get to that question in due course. I think you're among friends here, and there's I think many in our audience that, like you, have a soft spot for SaaS. Of course, very often when we're out dealing with clients, it's not going to be our choice or our advice as to whether a SIPP or SaaS is better for them, because that was, where another advisor trod 10, 20, 30 years before, and they've got an excellent pension vehicle, and it's now, into some sort of, life event. And maybe the business is being sold and that sort of thing. So we're going to go to our questions. We've got over 100 people live on the site at the moment, which is absolutely fabulous. So thank you all for coming. Please do submit your questions using the Ask a Question facility, and please do use the voting buttons. I'm going to go to Ian first, because our top question is specifically a SIPP question. Ian, people are asking, what tend to be the issues with group or corporate SIPPs? What should advisors consider when advising on this scenario for group or corporate SIPPs?
Yeah, again, going back to what I'd said in my intro, there are various definitions of this. People will call it a group SIPP. You're probably asking the wrong person in terms of, because I don't like group SIPPs, and with a SaaS it can be complicated enough, but you do have kind of professional people that usually set up a SaaS that have an understanding of the importance of engaging with transactions. And with a group SIPP, you tend to be dealing with, Joe Public in a lot of ways, who are pulling together. Now, if you think that, business directors and management falling out, as Barry had alluded to previously, you imagine a bunch of members of a family getting together and pulling their funds together. I've seen many cases. And again, it depends on the structure. I have seen a group SIPP. I mentioned it in one of my previous webinars, where it was a corporate trustee group SIPP, which of course means that the members are not individually registered on land registry, and it was completely bank driven. Now, what was happening was that one member was contributing far in excess of what the other members were, and what they were doing is, because the other member's share was depleting so much, they're actually outstripping that member's share of the fund deliberately, and it was out of spite. There are other corporate SIPPs. Corporate SIPPs were almost like kind of some hybrid between a GPP in a lot of ways and a SIPP, given the better investment choice that you got in a SIPP. But the main issues are not that dissimilar to what the issues you would have on a SaaS. Disputes tend to be, the common factor. My preferred solution, that if people want to, club together and buy a property, is really to do it through individual SIPPs, where each of their individual SIPPs buy a proportionate share of that property, and they get a proportionate share of the rent, and they pay a proportionate share of the fees. Because what you can tend to find is that if one member's contributing in a group SIPP, they're contributing more and more, but then again their liability towards the fees, as much as they can have a higher proportion, becomes larger. So their liabilities then become larger. But I think in this day and age, I think they were a great concept back in the day where SIPPs were a more advanced product. But let's face it, SIPPs, the word SIPP, is it even appropriate that we call it a SIPP anymore? It's, it was self-invested personal pension. I think a more appropriate term would probably be provider dictated personal pension, or regulator dictated personal pension, or even professional indemnity assurance dictated personal pension, because in a lot of ways, the assets that a company can offer is largely determined on what PI cover they can actually get for the assets that they're offering, the regulators' adversity to risk, and that provider's individual attitude to risk in terms of the assets that it offers. I mean, us ourselves as an SME SIPP provider, we've had to reduce dramatically the assets that we offer to ensure that our PI provision is still workable, and that we can trade successfully as a business, and also that we are overcapitalized in terms of cap add. So there's all these kind of different considerations. Now, with a group SIPP, going back to what we were discussing, individuals will all have different attitudes to risk. They might get together as a family and claim that they've all got the same attitude to risk, but that just simply isn't the case. Whereas an individual SIPP clubbing together to buy an asset still allows that individual to have their own attitude to risk. So if they're reinvesting their proportion of the rent, they can have their own investment strategy, which is completely different to the four other members that of their family that have clubbed together to buy that commercial property. And I think that's the key differential. We don't offer a group SIPP here. That's not to say that other providers don't do it, but I mean, for me personally, I think that they're kind of an outdated concept, and I think the far cleaner approach really is the individual SIPPs. But I am open to the rest of the panel completely just disagreeing with me.
Thanks for that. Yes, steer clear of those parking spaces, definitely. Barry or Martin, any thoughts on the group SIPP concept there?
I was just going to say I agree really. With a syndicate, you've got your share of that property, and where else you wish to invest for purposes of managing your risk or whatever, you've also got that element of privacy, which can be important, I think, especially. Well, not necessarily outside families, but certainly if it's not necessarily family members, it's that aspect of privacy and managing risk there. I'd be interesting, again, Martin might be able to help me out with this one, is the issue where one party wants to sell and others don't, or where the other parties want to buy someone out. I think with the syndicate, the agreements in place, so it might be, you got four syndicate property purchase members, one of them wants to sell, the others don't, then the agreement can be written such that the other three are given first dibs. So that's a helpful mechanism. And if three of them want to sell and one of them don't, then if that one person isn't able, willing, or prepared to buy the other three out, then the agreement can create a forced sale so that the majority get what needs to be achieved. So it'd be interesting to see Martin's experience of how that sort of arrangement works within a pool, whether it's a pool SIPP or whether it's a SSAS.
I think actually, Barry, you've nailed it there. I would simply suggest it's back to the building blocks. So from a point of view of looking at the construction of the product that you've got, sometimes, a group SIPP, there's two different things here. You can have a group of SIPPs, or you can actually have a group SIPP, which is quite often constructed as an individual entity, not dissimilar to a SAS. And I think it's management of expectations to avoid disappointment. Is you've got to understand exactly what you've got and exactly how it works, and understand exactly what the syndicate agreement says, because it's only when you get to a point of dispute that everyone actually goes back and looks at the paperwork and says, well, this isn't actually quite what we thought it was. So all the more reason for, and my point of view is, if it isn't evidenced it didn't happen, you may have a verbal agreement, or it might have been discussed in a meeting at some point that this is how this is going to happen. Get it down in writing. get it agreed by everybody, because that's the only way you are going to potentially avoid disputes at a later date. And the point Ian made earlier on, I think it's very important when you're setting up a SSAS or even a group of SIPPs, individuals have more than one hat. They're quite often, they are a director of the company. They will have a view on that. They're quite often a beneficiary. They will have a view as a beneficiary. But more importantly, they sit there with their trustee hat on. And the numbers of times I've sat in meetings and had to remind people which hat they should be wearing, it's frustrating. The belligerence that you've talked about before. I don't care if you do have a disagreement with your brother or so-and-so. You're acting as a trustee. You're therefore deemed to be acting in the best interest of the beneficiary. And if you fail to do so, although it is a long-winded way, we can actually take steps to have you removed. So do the job properly or face the consequences. Sorry.
Yeah, Martin, this is bringing us very nicely onto our next question, which has come in. It's specifically a SSAS question, and it's all about conflicts. What can be done to settle conflicts between SSAS members, which can come to a head during acquisition settlements? And perhaps while we're tackling that one, we can bring in the point that Barry mentioned at the beginning. We could regard a form of conflict is the member that just literally goes quiet and won't respond, won't sign things. Martin, some thoughts on conflicts, please.
Yeah, it does. It harks back to the point I've just made, I think, and that is just making sure everything is documented. I've got a situation currently dealing with two business partners who have been business. It's a property business. They own assets within the pension scheme. Everything is split between the two families on a 50-50 basis. And that is what they thought had happened within the SSAS. But of course, one member started to draw well before the other one. His share of the fund has reduced down. The capital value of the property increases, rental increases. Who's that allocated to? You've got the concept of a common trust fund, which proliferates in vast majority of cases, unless you've had an earmarking. And as Ian mentioned earlier on, earmarking is possible. It needs to be agreed by all trustees and all members, and it needs to be evidenced. If it's not evidenced, it didn't happen. The problems we face are that if you don't look at these things with a common sense and pragmatic approach and remind individuals which hat they're wearing, you just simply won't move forward. And when you've got this stagnant situation, it's no help for anybody at all, other than potentially the advisors who are desperately trying to get this matter sorted and are just racking up fees. The final resolution to this is if you've got a dispute that can't be settled, is to take it to an ombudsman. But we do know that taking matters to an ombudsman with the workloads they've got on, it can be 2 years before it even gets allocated, or 3 or 4 years before you get to a settlement, during which time, again, it's not in anyone's interest. So try and settle these matters at an early date, remind individuals the role they should be functioning in, and above all else, make sure everything's documented at the appropriate time.
Yeah, I think just to add to that, I agree completely with Martin. We've got a case where the ombudsman got involved, and the family. So it was split. There's 6 members. The family are split pretty much 50-50 because they've had a major falling out over an inheritance. 50% of the family gang up on the other 50% of the family. It's like 2 separate parties. Went to the ombudsman. The ombudsman, says that the scheme's not been maladministered, which was what they were accusing us of being. Really, what the dispute is that the 2 sides of the family need to, wear a separate hat, come together, forget that they're actually in dispute with each other, and make, a choice for the benefit of the scheme. But what they're looking at us to do as a SSAS provider is to sort out a family dispute, and it's not the Jenny McKyle show. And I think that's where a lot of families in dispute think that they're in dispute with the pension scheme, when in actual fact they're in dispute with each other.
Yeah, thanks, Barry. Have we answered your question about disputes and indeed when somebody goes quiet, or?
Yeah, I think so. It's all about agreeing. I think the sense I get though is that actually you can have a sticking point, and you can end up, like Martin says, having to go to the ombudsman and having to wait an interminable period of time to get it resolved. So I think there is just a reality there that you have to accept. I think in all likelihood, these problems are most likely to occur where there's a lack of liquidity, because if people are really fed up with each other and there's enough liquidity, they'll just move away. They'll transfer out if they've got any sense. So I think you're more like, I would suspect you're more likely to have these issues where people are falling out and there's a lack of liquidity so that people can't just escape. So that's again another issue. How much of this fund should be committed to, for example, commercial property purchase? What are the plans to create liquidity, future employer contributions, etc.? Because I think liquidity is going to solve an awful lot of issues. And we're not just talking about, someone wanting to leave, someone falling out with each other. We've got all sorts of issues. If someone goes into drawdown and they want to transfer, you've got to transfer the whole drawdown. You need liquidity for that. One of the members of the SSAS gets divorced, pension share in order. The ex-spouse doesn't want to be brought into the scheme. You need liquidity to create the share in order. So I actually think a lot of the issues ultimately boil down to a lack of liquidity.
Thank you. We've got a very pertinent question coming here, which I think probably happens quite often, which is that when a company is sold, what actually happens in practice is that the trade of that company is sort of moved across and amalgamated into the buying company. After which, of course, the original employer may simply be wound up. So our question is, what is the position for the SSAS when the employer is wound up?
Scheme documentation. This again takes it back to the building blocks. Right the way at the back of the deed, you will quite often have a clause that says principal employer, in the event of a change of control of, in the event of a winding up of, then the following shall happen. And it's not absolutely essential that in the event that the company is wound up, that the scheme needs to be wound up as well. I will admit that in some of the older deeds, that was quite often the case. But all the more reason why you need to look at the documentation well in advance of this, because if it does say that, you then look to see where the powers of amendment are. You then get the relevant parties to make the power of amendment that says in the event that the scheme of the company is wound up, then the powers are transferred to the trustees. The trustees can continue to operate the scheme. So again, nothing insurmountable, but just planning ahead of time.
Can I ask the benefit of your practical experience on this point, Martin? If you've removed the sponsoring employer, as I recall back, I think it's back in 2017, the grounds upon which the HMRC can move to deregister a scheme were extended to include a situation where an occupational scheme has in inverted commas, a dormant employer. What's your practical experience of the HMRC sort of looking at schemes where the employer has been removed for whatever reason? And are they typically looking for other, perhaps more serious issues before they?
I think you are. I think you're right. It's been fairly limited in that the numbers of times that HMRC have actually raised this in cases that I've been aware of is probably limited to one hand. Right. But I think in the instance they are genuinely looking at, and it's possible that, as Adrian said, the business might be transferred away, but the company continues as a dormant employer. It doesn't insurmountably mean that, well, in which case we're going to look to wind this scheme up. You can enter into the negotiations with the revenue on an individual basis and explain exactly what the situation is. In that instance, it's perfectly clear that it's not a dormant employer for the purposes of setting up a scheme and creating an investment and perpetrating a scam. It's been a perfectly legitimate scheme for the last 15, 20, 30 years. And it's a mature scheme, and this is how it's playing out. So
those provisions were what one would assume were introduced to deal with a situation where a shell company was created in order to create a SSAS, and then that company was just basically wound up, and it was all just a sham from the start. So your experience would be that actually in a legitimate situation where
I think it's very difficult for the revenue to be able to argue an instance in the scenario we've described where you've had a 20-30 year trading company. That's an issue, and even when the more so that you've even got rid of the founder employer, you can operate a scheme without the founder employer. But it drives back to the corporate advice received prior to the deal being struck. You've got a group of companies. Have you got a subsidiary that you can move the SSAS across to when you then sell off the founder employer, or even a group of subsidiaries which are all participate in the scheme? If you are taking out one employer, there's no reason why you can't substitute in a participating employer that may be a totally unrelated trading business, but connected to the original founder through, the original members. It's just, have that conversation with your SaaS practitioner ahead of the deal and see what the options are. It's business structuring as well.
Lovely, thank you. I'm gonna move us on. We've got a question coming in around property liquidity. I'm not surprised this question's coming. Some big name fund managers got into terrible trouble last year with property liquidity. But our questioner asks, as most SSASs invest in property, liquidity can become a practical issue, either as members reach retirement or indeed on disputes leading to exits. What do the panel suggest as the best ways to manage this issue of liquidity?
So I think, again, it's probably you should only ever enter into this type of transaction when you've got an exit strategy as well. And again, as Barry said, he's involved at the front end of these things. You've got to be planning for 15, 20 years down the line. There are some things you can sort of preempt in the event that you're putting money into a pension scheme. You're perhaps borrowing heavily, so you have no liquidity at all in the accumulation stage. Haven't necessarily got the retirement issues to worry about, but you do still have people transferring out issues, in which case, well, actually, can you transfer out part of the property in specie? That's one option. Can you raise a mortgage to raise liquidity? That's another option. If somebody dies, well, is it a good idea to put some key man insurance in place for those directors within the company, such that if one dies, the company can perhaps buy part or all of the property back from the pension scheme to provide liquidity to the pension scheme to then provide the benefit. It's a much wider area of advice, and I admit probably some that's overlooked in some instances, because liquidity is often an issue, particularly with transfers out and divorces, and particularly where, again, let the pension provider know well in advance if you've got something like a divorce in the offing, because once you actually get the sharing order, you've only got 4 months to do something about it, and that doesn't give you a great deal of time to plan ahead.
Ian, thoughts on
I would just quickly say that the question relates to SSAS, but a lack of liquidity could apply equally to a SIPP. So the liquidity issue isn't a unique issue for the SSAS, I wouldn't say. One thing you might do with the structure of a pooled fund, of course, is if you're bringing other members in, you could be transferring in their funds to create liquidity. Employer contributions for those members can create liquidity. And if it's a family business with a SSAS, mum and dad have run the business, bought the property, but then over time they brought the kids, even the grandchildren in. Those contributions, their transfers might create the liquidity that mum and dad need to take their benefits in retirement. So that could equally be achieved with a syndicate of SIPPs, but it's perhaps easier to illustrate. I'm thinking from a presentational perspective, that's easier to illustrate in respect of a pool fund, but that could work with the syndicate of SIPPs as well. But the point being, it's not a problem that's unique to a SSAS, I don't think.
Yeah. I would just say, I think one of the key things that people look at, of course, there's always going to be benefits of bringing a property into a SIPP or a SSAS. You've got the tax benefits, it's free from CGT, it's free from income tax on the rent. But I think this is where there has to be some foresight. Now in Scotland, as people will know, property prices are much cheaper up here than what they are in the rest of the United Kingdom. But when you look at it, we've seen cases. I've certainly seen cases in the past where the rental yield, the amount that they're bringing in rent per annum doesn't even cover the annual fees. So what is the overall benefit? They're not actually making any. They're not increasing the liquidity that way through a good commercial rent. But like both panelists have just said. This is where really planning at the start has to. You're not just planning to get the property into the. No point in bringing a property in that's worth 100k and you're transferring in 110k. Really you've got to think. There's fees to be paid. There's going to be rates. There's going to be a whole host of different things. You're going to have to cover your fees. Property annual fees, SIPP annual fees. So. Yes, there's always going to be the tax benefits, but you have to look, really what you want to do is increase some form of liquidity. And one of the key factors of bringing in a property into a SIPP or a SSAS is that a lot of people want to reinvest the rent. Well, there's nothing to really reinvest and grow if you're only bringing in not even enough to, to cover the fees.
Thank you. Excellent. Okay, I'll move us on to another SSAS question, but just quickly before I do, I just want to thank Kerry Houghton for filling in a comment just to remind us that whilst we debate the pros and cons of SIPPs and SSASs, there's not always an option to have them both. And for example, a group of professionals such as accountants and solicitors just are not eligible for SSAS, so they may need to go down the group SIPP route through having no choice. But moving to our sort of next most popular question, and please do keep voting for questions so that the ones that are most important to you get answered. It's a SSAS question, and it is, in your experience, how do advisors manage the risk profile of a pooled fund when the SSAS may have members of varying ages, some approaching retirement and wanting to draw benefits, with others perhaps having many years from being ready to take benefits? Profile with many different members. Thoughts, please. Who would like to grab that one?
I'll jump in then. It is a very difficult problem. You've got multi-generational SSASs, and quite often in owner-managed businesses, you will have exactly that. Where you've got an asset such as a commercial property. The idea being is, of course, it is illiquid, and when mum and dad get to wanting to draw benefits down, you would think that all the contributions that have gone in for the children have actually transposed them way across, and they're providing the funds to provide the benefits, so that the property gradually, if you like, moves across. Where you have a pooled fund like that, you do put together assets that are going to look at the individual family and the generational approach. I think it's probably more difficult is where you have non-family members of very, very different ages. You haven't got an asset like a property. You've got discretionary fund managers or pooled unit trusts and bits and bobs. It's not uncommon to actually earmark individual portfolios within a SSAS for individual parties. It makes the allocation process slightly more complex if you have pooled assets and earmarked assets, such as a property and earmarked portfolios. But all these things are possible. You just make sure that it's, the scheme practitioner understands exactly what you're trying to do, and that on an annual basis, everyone gets an annual statement that shows exactly what is their entitlement. You get instances where an individual, world events that are going on as they are, an individual might wake up on a Monday morning and find their attitude to risk has changed entirely from what it was the month previously, in which case they may want to take a different approach. They need to be able to do that. That's possible. If you've earmarked those assets, you can make the adjustments. So again, the point to make about earmarking is document it thoroughly, because it is upon those agreements that we'll need to rely at some point in the future in case a dispute arises.
I wonder where earmarking isn't technically possible within the scheme, it might be possible to create some sort of notional earmarking. That X amount of the fund notionally representing these members invested in this way, X percent of the fund notionally representing the members in this way. But I'm not sure that's ideal, really. But I think ultimately it could just come down to the word compromise. Do you value being a member of this pooled fund more than you are particularly concerned about your unique risk profile? Which is of the greatest advantage to you, having your own pension arrangement invested to absolutely match your risk profile, or being a member of this pooled fund with the benefits that you think that's going to bring? So I think there's, unless you've got the option to earmark, I think there's always going to be some element of compromise there. But whether there's this, like I say, there's potential to potentially to a degree notionally earmark, maybe.
Ian, members of very different ages and different risk preferences.
I think this is where individual circumstances are not a stationary thing; they're constantly changing. there's conversations that need to be had as to whether or not I would say that member even wants to remain in the SSAS. Is the SSAS necessarily the right option for them? And certainly the cleanest thing for me is, perhaps they never intended to take benefits. They plan to just, keep working, keep contributing forever and ever. Is it the right time to have a conversation with that member to say, okay, you're about to enter the decumulation stage of your would it be right now actually that you get a transfer value, move into an individual SIPP before any of that? Because if you've got the generational things, perhaps you've got mum, but perhaps the kids, as Martin was alluding to, earmarking orders, they can become more complicated. They need to be well documented. Circumstances change. They're a constantly moving thing. And they might actually decide it's cleaner when they're entering into the decumulation stage to actually, do you know what, you guys carry on. I want to be completely separate. Don't know what my circumstances are going to be. So let's transfer me into a SIPP or, a PP. And let me just get on with my own thing. I don't need to be part of that anymore. I'm passing the business over to the younger generation. So I'm quite happy to come out of this. That's certainly an option. It certainly would be much easier to manage the risk profile because you're then not dealing with all the other members' trustee. You're just dealing then with that member and the decumulation stage of their life.
Ian, you've moved us perfectly on to the next question, which has come in, which is that when you do have directors like that a couple of sort of top directors have retired and have taken most of the money out into their own personal pension vehicles of some shape or form, what's left behind? Is what's left behind going to be a viable SSAS, or how should that be dealt with?
Well, it's a viable SSAS if it's still a trading company. If you've still got, as I've just mentioned, if you've got mum and perhaps the 4 kids, and the plan always was to, kind of leave the business to the 4 kids, and when I reach a certain stage, I'm going to transfer into a SIPP because I really don't need anything to do with the business anymore. You tend to have people that tend to find that they have to remain in the SSAS. They're not allowed to SIPP, and if they've been in a SSAS or whatever. But for a lot of people, it actually would be a lot cleaner just to move them in. And it certainly makes managing, yes, of course, you can have your marking orders and but it certainly makes it much cleaner in terms of if an advisor is managing all the clients, because the client, the advisor might have all 5, members of the SSAS as their own individual clients. It might make, managing the risk profile easier because, as you say, somebody in the decumulation stage might actually not have the same attitude to risk as the younger generation. The investment choice, and it can become costly. This is the thing when you're putting in earmarking orders and actually I've changed it again, or this member's changed. It can be cleaner sometimes to actually assess on an ongoing basis whether that SSAS remains the right thing for you. But I would, I'd be interested to see what Martin thinks about that.
I'd simply say regular communication is the key. Because this is the advantage. I'm going to say it now. Regular trustees meetings. It's only when you, as a pension practitioner, you get to meet the members with the advisors and actually have those discussions. I know email is great technology, super stuff, but it doesn't substitute the fact that you talk around the subject far more in a face-to-face meeting, and I think you pick up lots more from that. And it will trigger, if you are thinking that, don't forget that, and that. So, regular communication is the key.
Yeah. And I think actually there could be a comeback for this now, because I think a lot of the, it was always kind of determined, especially if you've got geographical differences as to where your client base is held. A lot of people, I certainly didn't, I'm a bit, maybe young looking, but I'm certainly old fashioned in terms of my approach to technology. I don't, I never really liked doing Zoom calls before COVID happened, but, I think even now the older generations that were a bit technophobic, they've been forced into this position now where it's become part of day-to-day life. So actually arranging trustee meetings isn't about, getting everybody into a room and trying to arrange a time where they can all come and visit an office. Interactive meetings can happen over Zoom and whatever else these days.
Ian, this question of age, I think, takes us into what's going to have to be the last question of the session, I'm afraid, and it's around capacity of the industry, particularly bearing in mind that many of us in the SIPP and SSAS world are of sort of increasing age. We've seen a number of SIPP and SSAS firms consolidate together in recent years. Our questioner simply asks, does the industry still have sufficient capacity to, manage the extant SSASs that are out there? So quick answer from the three of you, please. What is your view on the capacity of the industry to handle all the SSASs that are still going?
Yeah, I think, I mean, companies, I think, need to assess whether or not they do have that capacity and whether or not SSAS is, there are a lot of SaaS companies now that are springing up. Martin works for one of them, that actually, that is their bread and butter. Now, for a lot of companies, I mean, we're lucky enough because we are, we're quite a, smaller, SIPP and SaaS provider. But there's also companies that are out there that are large providers. Now, when you have a brand, people, even though the SaaS side isn't necessarily regulated, you're almost guilty by association because you are a regulated umbrella. The SIPP aspect often comes under that. Now, really, I think for is there better consumer? There needs to be more consumer choice. But I mentioned it on the previous webinars. There's been dramatically, the SIPP industry has shrunk. Years ago they used to have something called the Monopolies Commission. I don't really know where it applied to the SIPP industry because it seems to have, kind of bypassed that completely. But there's a lot less choice now, and with SIPP, with SaaS, it's going through this kind of renaissance where smaller companies actually think, that this is our bread and butter. This is where we can really concentrate on doing a good job. But I think it's a difficult question. Bigger doesn't always mean better, but nor just smaller, as we've seen over recent years. But it's about assessing, whether or not you can offer that choice. And the important thing is that SaaSs aren't regulated. So it's important that regulated companies, whilst you can, it's prudent to apply the same kind of diligence and, corporate risk structure, you are dealing with an unregulated product, and to over-regulate something that isn't regulated actually takes away from some of the advantages that are available under SaaS.
Yeah, lovely. And Martin, I'm going to give you the final word, if I may. Your incoming chair of AMPS, your view on the capacity of the market.
I think there is capacity. I think all the while for SIPP and certainly for SaaS, all the while these things exist, there will always be people of interest and interested in doing it. I started working in SaaSs when I was 18, and I don't think there's any other type of vehicle that I've seen where you can be as actively involved in scheme constitution, benefit design, benefit payments. Investment teaches you about loans. It teaches you about property. It's an enormously wide career choice. And certainly, the account managers that we look after, they have an engaged relationship with their clients. It's a very, very rewarding role. So I think, there's always going to be capacity to find people who are going to want to do that.
That is good to hear and very reassuring. It's now down to me to say thank you very much to our three speakers, Barry, Ian and Martin, for giving us your time. Thank you to our audience for lending us your lunch hour. I hope you've enjoyed that too. If you followed the chat, then Alex will be looking after the issue of CPD certificates in due course. We'll be continuing our series of lunchtime webinars at Dunstan Thomas over the summer. I don't have an exact schedule of dates and topics, but you're on our email list, so don't worry. We'll be in touch. Keep a watch on your email in basket. Thank you very much for coming. I hope you have enjoyed your lunch hour. Cheerio, everyone.
Thank you, everyone.
Thank you.